Welcome to The Explainer. Today, we are doing something I absolutely love. We're going to take a company, dig deep into the numbers, and put it through the ultimate valuation gauntlet. The company on the hot seat today, CenterPoint Energy, ticker symbol CNP. As an investment analyst, I want to know if this stock can survive the strict, legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham. And just for good measure, we'll top it off with some modern discounted cash flow and dividend discount modeling. Let's jump right in. We've got a packed agenda. First, a quick snapshot of CenterPoint, then we'll view it through the Buffett, Lynch, and Graham lenses. After that, we'll run the DCF and DDM models, and finally, bring it all together for our final verdict. All right, Section 1, the CenterPoint Energy snapshot. Right now, the stock is sitting at $40.54, which gives us a solid 2.27% dividend yield based on an annual payout of 92 cents a share. They've got a payout ratio around 54.7%, and honestly, for a utility company, that is incredibly healthy. Plus, they've been bumping that dividend up at a rate of 5.75% over the last year. So if you're an income-focused investor, on the surface, this looks like a very stable, cash-generating utility. But here is where things get wild. We are looking at an explosive scale of projected growth. CenterPoint is anticipating 14 gigawatts of eligible base or studied load by 2031, which is heavily driven by the booming demand from data centers. Just to put that into perspective for you, that is a more than 65% increase over their current peak system demand. But of course, that kind of hypergrowth doesn't come cheap. It requires a staggering $66.7 billion capital plan over the next 10 years. To help pay for this, they're already asking regulators for rate increases like a recent $108.1 million request in Texas. So we've got this massive tension, incredible growth potential versus mind-blowing infrastructure costs. Moving on to Section 2, let's look at this through the Warren Buffett lens. You know Buffett loves an economic moat, right? And as a regulated utility monopoly in Texas and a few other states, CenterPoint definitely has a massive one, along with highly consistent earnings. But Buffett also demands manageable debt. CenterPoint recently issued junior subordinated notes rated BBB by S&P. That signals a pretty heavy debt burden. Sure, that's somewhat typical for utilities, but it's definitely a knock against them in the Buffett playbook. Now, Buffett is absolutely obsessed with what he calls owner earnings. Basically, it's the actual cash a business can generate for its owners after you subtract the capital expenditures required to just maintain the business. And this concept highlights a major hurdle for a capital-intensive company like this. Remember that colossal $66.7 billion capital plan? That averages out to over $6.6 billion a year. Because of that, CenterPoint produces virtually zero owner earnings. Yes, their net income looks fine on paper, but when you subtract the literal billions they need to build out the grid for these new data centers, the actual cash flow left for the owners just vanishes. Because of this, Buffett would almost certainly pass on this stock at $40. He demands a huge margin of safety for businesses with this level of capital intensity. Okay, Section 3, the Peter Lynch lens. Let's talk growth at a reasonable price. Peter Lynch famously liked to group companies into 6 distinct buckets. Given CenterPoint's steady dividend and management's guidance of about 8% earnings growth, they fall perfectly into the stalwart category. Stalwarts are great. They offer solid protection during recessions, but they aren't going to double your money overnight. The magic metric for Lynch is the PEG ratio, which is just the price-to-earnings ratio divided by the growth rate. If we use CenterPoint's 2025 midpoint EPS guidance of $1.90, we get a PE ratio of 21.3. Divide that 21.3 by their 8% projected growth rate, and we land on a PEG ratio of 2.66. For Lynch, a PEG ratio over 1.0 is a glaring red flag for overvaluation. So at 2.66, you are paying a very steep premium for that 8% growth. Add in the BBB debt rating and a lack of clear insider buying in our data, and this shapes up to be a sell, or at best a weak hold in Lynch's eyes. He simply wouldn't pay 21 times earnings for an 8% grower loaded with debt. Let's pivot to Section 4, the Benjamin Graham lens. Time for some old-school defensive value testing. Graham is the godfather of value investing, and his checklist for the defensive investor is notoriously unforgiving. CenterPoint easily passes his test for adequate size, earning stability, and a rock-solid dividend record. But Graham wanted a moderate PE of less than 15. CenterPoint sits at 21.3, so that's a fail. He also wanted a price-to-book ratio of less than 1.5. Now, while our specific data doesn't give us the exact book value, utilities almost never trade below a 1.5 PB in today's market, so it's highly likely a fail there too. If we try to run Graham's intrinsic value formula, we have to make an educated guess on that book value per share. Assuming a fairly generous $15 a share for a utility this size, let's do the math. The 22.5 constant times the 190 EPS times the $15 book value gives us roughly 641. Take the square root of that, and Graham's intrinsic value comes out to about $25.32. Knowing Graham wouldn't touch a stock without a 30 to 50% margin of safety, the current $40 price tag is a hard pass. All right, Section 5. Let's step away from the gurus and crunch the numbers with modern DCF and DDM models. A standard discounted cash flow model, or DCF, relies entirely on free cash flow. But here is the kicker for utilities. CenterPoint's required capital investments of $66.7 billion absolutely crushes their free cash flow. When you're spending more money building out the grid than you're generating from your actual operations, a traditional DCF model tends to completely break down. If we were to force a DCF anyway, we'd have to make some aggressive assumptions. Assuming a weighted average cost of capital, or WACC, around 7.5 to 8% to account for that BBB minus credit profile and today's interest rates, even tiny changes in our terminal growth assumptions cause the fair value to swing wildly. It's simply too sensitive to those staggering CapEx numbers to be a reliable tool here. So, because the DCF is so messy, we pivot to the dividend discount model, the DDM. This values the stock based strictly on the present value of its future dividends. Plugging in that 92-cent payout and their very reliable 5.75% dividend growth rate, and assuming an 8% required rate of return, the DDM gives us a fair value right around $40 to $41. This tells us that purely as an income vehicle, CenterPoint is trading right at its fair value today.
Finally, Section 6. Synthesis and the final verdict.
Let's consolidate all our models. At $40.54, the stock appears fully priced or outright overvalued across almost all of our historical frameworks. Buffett is out because of the massive capex. Lynch sees an overvalued PEG ratio. Graham's formula points to an intrinsic value down in the 20s. Literally, only the dividend discount model suggests it's fairly valued right now. So, blending all of this together, our final verdict as analysts is a hold. We have to balance the unprecedented upside of 14 gigawatts of new data center electricity demand against the astronomical cost of building the grid to actually support it. The strengths are absolutely there: a regulated monopoly, $5 billion in projected customer savings, and massive baseload growth. But the risk of carrying BBB debt to fund a $66 billion build-out is massive. Now, if the stock were to drop into the mid-30s, the dividend yield goes up, the PEG ratio normalizes, and suddenly we're much closer to a true buy signal for a stalwart investor. I want to leave you with this final thought. In this new era of AI and data centers, are these massive capital risks just the unavoidable cost of playing the grid expansion game? Think about it. If utilities like CenterPoint don't spend the $66 billion, those data centers literally cannot be built. They hold the keys to the future, but as investors, we have to decide if we are the ones willing to foot the bill. What do you think? I really hope this analysis gave you a fantastic framework for evaluating utility stocks. Keep testing those assumptions, and I'll see you in the next explainer.